Also with us, Charlie Bobrinskoy. He helps manage $3 billion in assets at Ariel Investments. He also runs the Ariel Focus Fund, which is in the top 20% of its class over the 1- and 5-year periods. Charlie, good to have you back here on Street Smart. Bunch of selling. You said to me in the break, I always seem to have you on when the market is selling off. What do you make of this latest round of selling here?
Fear and uncertainty are bad for financials. People right now are assuming very bad things, and that's reflected in some historically low valuations. You've got the big investment banks trading at the lowest multiple of tangible book that I can ever remember in my 30 years in the business. So we think it's overdone, but I have to admit I said that 10% higher than here.
What about, you mentioned financials. Morgan Stanley is seen as risky as Italian banks if you look at the credit default swaps market. I mean, does that make any sense to you? You own the name. Is it hurting you to own this one?
Absolutely it is. It's down almost 50% this year. We think it's nowhere near the peril. It doesn't have the sovereign credit exposures of the European banks. It has a very liquid balance sheet that is easy to price. We think it's easy to see through what Morgan Stanley owns. There was a report today that they have large foreign exchange exposures. Okay, but they don't have large foreign exchange losses. So I think the stock at this point is assuming a really, really bad set of losses that we just don't see the evidence for.
And I know we're going to dig deeper into Morgan a little bit later, but Matt, I know I want to get you in here as well.
Yeah, well, why don't I just go ahead and give you the closing numbers as we hear the bell ringing behind me right now on the New York Stock Exchange. The Dow Jones Industrial Average driving lower into the close on this Friday. 240 points the drop now. 10,913 the level there. And we just slid further and further down as we approach the close for the last 10 or 15 minutes or so. The S&P 500 down 2.5% at 1131, a drop of 29 points. So still 11 points, Carol, above that 1120 level that we've really been watching for months now, it seems. And then NASDAQ down 2.7%, taking the biggest hit of the bunch, 2415. The reason is tech stocks got hit hard today, including some of the PC makers. And I want to ask Charlie here, is it that fear and uncertainty that's the problem for this market, or is it that we're getting more certainty on earnings? AMD cutting its outlook, Micron missing its earnings forecast. I mean, it seems like the E in next year's PE is getting smaller and smaller.
I'd push back on that. Accenture had a very good number in tech spending. They took their guidance up. So far, Dell's numbers were fine last quarter. There's absolutely fear of big revisions, but I would push back on the concept that we've had big earnings revisions downward.
You like Dell. It's one of your top 10 holdings. Are you optimistic for PC sales going forward?
I would say that the current stock price is extremely pessimistic, and I'm not nearly as pessimistic. If you take into account the cash that Dell has on the balance sheet, it's trading at around 8 times earnings. It had solid growth. We're still only in the middle of the PC refresh, and PC sales in the emerging markets continue to be strong. So people are assuming the iPad's going to knock desktops away forever, and we just don't think that's going to happen.
Hey, let's go back to financials, guys, for a second, because, I know it's been a tough group for you, Charlie. It is one of the worst performing groups today, the worst performing group of the year. Adam, let's bring you back into it, because I want to dig a little bit more deeper into Morgan Stanley today, because it's certainly been one of the names to watch here.
Yeah, it sure has been. And, Charlie, I certainly don't want to beat you up on Morgan Stanley. The market's been doing that. You don't need me to repeat down 50%. There's a chart right there. But as I was talking to traders around the street today, I got an interesting couple of comments, and that was that there's a correlation between Morgan Stanley's performance on days when you have news about China property prices, and that perhaps there's some exposure there that the market hasn't quite quantified, and maybe that's why the credit default swaps are so much higher. It's real hard to try to quantify that because Morgan doesn't necessarily break this stuff down for us to make it easy. But can you sort of shed some light on where the exposures might be at Morgan Stanley, and if there's any truth to this notion they have exposure to Asian property prices?
There's a new rumor every day on what's driving it down, and that comes from the fact that there's no actual evidence of any big losses that are coming. So people come up with new speculation every day. Look, in a world in which credit spreads are widening, when the typical trade that an investment bank does is to go long a credit and hedge with a Treasury bond. There are probably going to be losses in fixed income. That's absolutely right. Any positions on the equity desk are worth less than they were last quarter. So I'm not saying they're going to have a good quarter, but I am saying with a tangible book at $23, $24, the stock is worth more than $13.50.
And any comment about whether or not there may be exposure to Asian property? Is that something you can quantify?
No. The short answer to that is no. I'm sure there is exposure to Asian properties, but nobody has come up with the multi-billion-dollar losses that you would need in order to justify this kind of run. Asian property is actually doing better than real estate in other parts of the world, so there's nothing that I can put my finger on that would explain this kind of dislocation.
Listen, I don't want to beat you up on financials either, but you do have a fair amount of exposure. You know, Charlie, Morgan Stanley, JP Morgan Chase, you've got Goldman Sachs, Citigroup, Bank of New York Mellon. Any feelings that you want to pull back a little bit on your exposure, or you're going to ride this one out?
No, absolutely not. This would be the absolute worst time to sell these stocks. There's a huge amount of fear that's been driving these things down. Goldman Sachs and Morgan Stanley are trading at the lowest multiples of tangible book since Goldman Sachs went public. These are very low valuations, but I'm not going to deny if fear levels go up higher, these stocks are going to perform badly. The good news is we are starting to get closer to an earnings report where I'm hoping that people will see that the rumors of big losses aren't going to materialize.
What are your thoughts, Charlie, on the U.S. economy? We tend to focus on these bank stocks so much on what's going on in Europe, their exposure to that continent, their exposure to Asia. What about the U.S. economy? Because it's been tough here as well, and Bank of America, for example, raised a lot of eyebrows when it said it's going to start charging customers for using debit cards.
Yeah, Bank of America is a little bit different situation. The liabilities at Bank of America are very real. The lawsuits over the Merrill Lynch acquisition, the puts of people putting Countrywide back, those liabilities I can see. And so we are not an investor in Bank of America. But right now, I think you're right, Matt. I think people are pricing these securities like we're going into a recession, a double dip. While that's possible, I'd personally put the odds of that at no more than 30%, maybe 35%, but certainly not the certainty that people seem to be pricing into these securities.
Is there any chance, because obviously a lot of the headwinds for these banks, especially one like Bank of America, are the regulations coming out of Dodd-Frank. Is there any chance that we get these turned around going into an election here?
Absolutely. I mean, if we had the Republicans take the Senate back and if they took the White House back, financials would do very well in that kind of environment. The whole tone of the regulatory tsunami would change, I don't want to say overnight, but the tone would clearly change, and financials would be a major beneficiary of that.
Hey, guys, hang on for a second. I want to get a trader's perspective. Add that in. Michael Gurka is Managing Director of Spectrum Asset Management, joining us from Chicago. So, Michael, the week, it's almost over, thank God. I mean, it's been a rough one here. What are you guys setting up for next week? I mean, we do get the monthly jobs report next week. Is it still going to be a lot of volatility? Are you seeing lower moves here? What?
Technical breakdowns without question in stock indexes. At the same time, the financials always lead credence to those movements. The dollar looks good right here as the euro gets ready to breach 134. A lot of anticipation coming into this week that you're going to see grains break through technical support, which it did, and has thus thrust itself into an open interest scenario where they're looking for more follow through. And lastly, I would not be surprised if you started seeing a little bit more emphasis on Treasuries getting bought, lower yields. I mean, it's not the same story, but with high volatility and with doom and gloom kind of ripping around here, I wouldn't be surprised.
You mentioned Treasury. Suzanne, let me bring you in. Bonds, having their best quarter since 2008. We keep talking about it all week, about how they've really outperformed here.
That's right, and today was no exception, Carol. As stocks fell, investors continued to buy bonds, extending the best rally for Treasuries this quarter than we've ever had since 2008. We have the 30-year yield below 3%, the 10-year below 2%. And Charlie, I want to ask you, I know you're not a huge fan of Treasuries, but in light of what we've seen just in the past couple of months with the gravitation towards safer assets, is it time to perhaps shift some of your money into Treasuries as we get into the fourth quarter?
No.
Why not?
The best time to do that was before they rallied to historically low levels. I mean, again, I've been wrong on this for the last month or two, but we're now at levels where I think you've got a one-sided risk-reward relationship here. We've got 10 years, you said, below 2%, even with a whiff of inflation, which I think is a relatively high probability over the next 3 or 4 years. Those yields can double quickly, and you could get your head handed to you in a 10-year Treasury. Obviously, we've got big deficit problems. One way of getting out of that is to print money, which would not be good for inflation over the long run, and Treasuries would perform very badly in that environment.
All right, Michael, hey, just got a few seconds left here for you. So what are you going to watch for next week? I mean, again, like I mentioned, we've got the jobs report. It's not looking like it's going to be a really strong one, maybe a little bit better than we got last time around. But nonetheless, what's kind of the early indications here?
Well, I mean, clearly the S&P's right here. That 1161 was a huge level of resistance. I would hate to hear what your feedback's going to be on this exact same program over the next 5 to 7 days when you have the S&P 50 lower. And I'm not just making that number up, but we could easily get there. I mean, the problem is we're getting used to this, okay?
Yeah, unfortunately we are. Hey, Charlie, you getting used to this? Are your clients getting used to this, all this volatility, all this selling?
You know, I'll say one thing on this point. Institutions have been less panicked. There have been less redemptions than there were in 08, 09, when everybody was very afraid. Institutions have been sticking in here. I think people are looking at multiples and saying this market is just too cheap to sell. They're not happy with the volatility, but I don't see institutions panicking at this point.
Maybe we're just getting used to it all. It's kind of crazy, but maybe that's what's happening. Hey, Charlie, we got to run. Charlie Bobrinskoy over at Ariel Investments, thank you so much. And Michael Gurka out there in Chicago, our thanks to you as well. Have a great weekend.